single most bullish thing for Bitcoin since Bitcoin has already happened. It's the American ETFs that have come out. And when I said this last August, people said, oh no, that's not true. What about if another country comes in? What if this comes in? What if that comes in? I hope you're starting to see why what I said was true with the downstream effects of this ETF. The ETF is like the butterfly that's just sort of woken up and is now going to start spreading its wings and flapping its wings. And all of those effects are going to go over to different parts and different things in the world. And one of those things is what I believe is the next most bullish thing for Bitcoin since the ETFs, well, since inception, since the ETFs. And then this next topic that I want to discuss today and just take a few seconds to discuss. Now, I haven't ever spoken in detail yet about this topic. And the reason why I haven't done that is because it's tough to explain, right? If you don't understand how the guts of the financial markets work, this part is going to be tough to explain. It's sort of easy to explain an ETF. It's like a company that owns Bitcoin. You own a piece of the company, done. But what we're going to talk about now is slightly different, and it's going to be a little bit more intense. However, I believe this is the single most bullish thing that can come for Bitcoin since the ETF, right? And it's about to come, so we'll probably have this in a few months, and that is options, right? That is derivatives on top of the Bitcoin ETFs. And this is a huge, huge thing for Bitcoin. And again, I want to keep people updated on this sort of stuff. This to me is more important than reading the news to you. And I think that's getting tiring for a lot of people. So please make sure you subscribe to the channel and follow on Twitter too, because this is what I believe is the future for Bitcoin here. This is now starting into developing the guts of the market, and that's what's important. And by the way, I'm going to do a video and talk about why Larry Fink is essential for this and why there is no better person than Larry Fink to actually execute this. So please make sure you subscribe to the channel for that. There is a little bit of, a little bit of dark, sinister perspective to Larry Fink's opinion on Bitcoin from what I've discovered, but I want to put that in a whole video, so make sure you please subscribe to the channel for that. Now let's get into this, right? Options are a whole betting market on top of the underlying spot market, right? When you place a bet, right, or you buy a call option, you are betting that the price of the stock is going to go up, right? And you are asking somebody to hold that for you to allow you to take the lift on the share price. Now, I'm going to simplify this as much as I can. I'm going to read from a tweet that I put out, which it was received quite well, because I don't really know any other way to simplify it. So I want to just cover this and try and get it as right as possible, right? So when you buy a call option and bet that the price is going to go up, right? The provider, the market maker, has to hedge the risk of you being right, right? Now let's simplify this even more and say that the market is selling oranges, and the market allows people who want to eat that orange next week, not necessarily right now, to come and buy a promise, right? A note, an agreement that they will buy that orange next week, but at today's prices. So let's say the orange is $1, right? And they want to buy it next week. They're going to give you 5 cents right now for you to hold that orange for them until the next week to buy it at $1. So the bet that they're making is that the orange will cost $1.10 next week. So they've put up 5 cents today. They will pay you $1 next week and be up 5 cents on the orange compared to everyone that will buy next week, who will have to buy it for $1.10. Right? The issue is that if the market's data shows that the orange will probably be worth more than $1 next week, the market maker, right, the person selling the oranges, you're setting yourself up to lose money, right? Because they've agreed to sell it to you for $1, but they could have sold it next week for $1.10, and they know that, right? So the market also wants to profit from that also. So what can they do? Well, they can go into the market and buy some oranges at today's value to hedge the risk of you buying the orange for $1.05. And assuming they think that the price is going to rise, Now they really need an orange position long themselves, in addition to the bet that they've allowed you to make on the stock that they already had, just to make sure that they don't lose any future profits. So they go into the market. This is the market maker, right? Goes into the market and buys up some oranges to offset any losses that they might have had from the bet that you took on their oranges today. So the magic here, understand what's going on here, right? If I'm the market maker and I allow you to bet on the price of oranges, and it looks like you're going to be right, I now need to go and hedge my position, right? And I need to go and buy oranges in the market in order to take up that profit that I'm going to make, right? So the magic here is ultimately that they need to buy the oranges in the market at a pace and speed that matches the speed at which the market price for the oranges increases. So if the orange is going up, say, $2 in 2 days rather than $1.10 in 7 days, they need to buy more oranges to mitigate their loss on the promise that they sold to you. So they have to buy more oranges to make up the loss that they're going to make, right? Because the price of orange is going up through the roof. This might work really fine in a world where you have a fresh, oscillating supply of oranges coming out weekly, right? Like next week there's 1 million oranges, week after that it's 1.5 million oranges, and the week after that it's 900,000 oranges, etc., etc. But only one thing happens when there's a finality of supply on those oranges, right? If you knew that this week or for the next 4 weeks you're only going to get 1 million oranges a week, you just know that already in advance, and that's the beautiful thing about Bitcoin. We already know that in advance. So what happens is that they chase up the price, right? And as the price goes up, more bets are placed because everyone's like, wait, look at the value of those promissory notes that were made. They're worth way more now. I need to get into this trade, right? So they place more and more and more bets, and the market maker has to place more and more covers, and they have to go out and buy more oranges. So you turn into this crazy loop where you're just driving the price up and up and up. So the market has to monitor the price movements of oranges 24/7 and secure their position so that they don't lose, right? As the market maker, I need to keep an eye on what's going on with oranges 24/7 and readjust my position to make sure that my risk is hedged, right? And the crazy part is that if one orange is $1 and you can place a bet to control that specific orange for 5 cents, now for $1 you can actually control 20 oranges. Right? So the market maker has to go and hedge the risk on 20 oranges, not just one. And this turns into a feedback loop, driving the price up aggressively and also down aggressively in a down market as these bets get placed. This is what the introduction of options is going to bring to Bitcoin, especially options on the ETF, because now everyone can get into it. Right now, right, $1 billion, when I wrote this tweet a week ago, $1 billion could buy you 16,000 Bitcoin, right? When you have options, $1 billion would allow you to control 80,000 Bitcoin. So the same amount of dollar value is allowing you to control 4 or 5 times more of the underlying asset, right? And of course, you're controlling 80,000 Bitcoin now, by the way, of which the risk of the price adjustments need to be hedged and protected from loss, right? This is known as delta hedging. Right? And market makers will be buying up Bitcoin for their balance sheet just to allow people to take bets on the directional price of Bitcoin. This is so huge. No one's really talking about this because delta hedging, it's a confusing topic to talk about. People don't really understand it, but I'm trying to do a good job here to help you understand why this is such big news. There are people who are going to be waiting, salivating, right, for the options markets to come out on these ETFs, because this is the preeminent way for market makers to not only make money, but also for customers to take bets on the price of Bitcoin. And you could have, let's say we've had $8 to $10 billion going to these ETFs. You could have had $50, $100 billion being betted on the ETF, right, on which way it's going to move. And for all of that, the underlying market maker has to go and secure the asset to delta hedge, to make the risk neutral for themselves on whichever way your bet is going to go, right? Now, as I hope you can understand, this is absolutely tremendously bullish, because instead of that $20 billion that the ETFs have had to buy for a spot, you could have $100 billion in bets around that $20 billion spot market that the market makers need to manage risk on, right? And then you add in consistent ETF inflows continuing, add in registered investment advisors, add in retail, and you have a cocktail for driving price that no one has ever even dreamt about yet. This is like the stuff of the best Bitcoin wet dream that you can think of. So that is the power of options that's coming into the market, and it is the single most important thing since the ETFs that in terms of price action here. And if we add, if we 5x the amount of investment going into Bitcoin based on what we see now, right now we're looking at like $250, $300 million a day worth of inflows going into these products, into these ETF products. What if that was, immediately $1.5 billion net, right, going into and betting around these products? So yeah, it is exciting what's going on here, and the options markets are going to be phenomenal. But of course, it's extremely risky, but that's what traders do all day, right? Traders decide to take risks, and they have to hedge those risks, and that's how the market works. But that is coming. And so if you didn't already have enough competition for buying Bitcoin for yourself and your family, and you wanted your last name to mean something, you now got market makers that are going to start buying up Bitcoin as well. So you'll be sucking out the Bitcoin from the market faster than we've ever experienced. And we're already experiencing paces that we can't understand. And we're about to get paces that we cannot understand times 5, right? So this is the starting of the butterfly flapping its wings. The ETF was the main thing. Now this is a downstream effect of it with the options, and you're going to see these things develop. And one thing that I want to tell you is I want you to subscribe to the channel, because I'm going to put out a video on why Larry Fink is absolutely essential to this, and I don't want you to miss that. And it's because of his history and his past, and I'm going to break it all down so you have a better idea of why Larry Fink's hand of blessing, quote unquote, Bitcoin is extremely important. Some people are not going to like that, but it's absolutely the truth because of his background and what he's managed to do in his career. So subscribe to the video. But remember, despite all of the options, despite all of these things coming into play, and I still think this is going to be the single most bullish thing since the ETFs, and probably for the next 10 years, it's going to be ETFs and options. There are always only 3 rules to Bitcoin. Step number 1, you buy Bitcoin. Step number 2, shut the fuck up. And step number 3, you get fabulously wealthy.